Hi, and welcome to the podcast with me, Chris Pollock. My esteemed colleague Z isn't with us today, so we thought we'd mix it up a little bit for you. We spent a lot of time over the last few weeks and months talking about Donald Trump and the news impact on markets. Today, we're going to have a look at something slightly differently, something that you can rely on, or at least be observing every single month, something that consistently occurs in the markets, and explain how this can be used to help your trades, specifically around the S&P, NASDAQ, and some of the European indices that we'll touch on. Again, what we're talking about is option expiry. Why? Well, today is option expiry for the major indices, for the S&P, for the FTSE 100, for the DAX, and we're going to go through a few examples of, well, how this can help your trades. We'll look at it in the very short term, first of all, by looking at the European markets, and we'll look at it with a longer view of how this can cause potential continuations, potential reversals, always around this time of the month. Crucially, why and how you might want to use it going forward. So let's dive right in, maybe with the charts. Let's take a look at this morning. And for eagle eye viewers, for those of you who understand volume, it's not a surprise that at the opens, 8 o'clock in the morning, you tend to see a little bit more volume traded in the indices. Why? Because that's when the market's open. So if you were putting orders in to your brokers overnight, that's when you'd likely be getting filled early on in the day, if that was the market on open order you requested. So a lot of volume traded on the opens, but you'll see there's an unusual volume spike at 10 past 10 today. Now, this is when the time at which the options are expiring on the FTSE, on the ICE contracts. And this is why we see this big spike in volume, abnormal amount of volume for that time of day. And this is something that can cause, as we'll see in the DAX, often quite interesting highs and lows in markets today. It was very much the case in the DAX. But this is more of a warning, really, for those of you who day trade, right? Do not hold positions through option expiries. A lot of volume goes through and it isn't always predictable. So to understand whether we're going to get this big move up that we got in the volume, or whether we're going to get a big move down, or whether we get something that is a bit of a sweep in both directions, all of these things are possible and the ranges can be incredibly wide. So if you are trading on option expiry, we'll show you when this occurs in a moment, but be aware on the FTSE that between 10:10 and 10:15, this is when the options expire. This is when that volatility kicks in. So this is more of a risk management message to you all. On option expiry Fridays, please be aware of 10 past 10 on the FTSE. In Europe, on the Eurex, these products expire slightly later. So for the DAX, well, it doesn't take you a lot to work out when this occurred. You see the volume at the open again at 8 o'clock being especially high. Well, we actually had more volume traded today on the DAX when their options expire. It's between 10:55 normally into 12, and we had this big 10:55 into 11, and this was that 10:55 10 o'clock to 10:55 move. This ended up being the high for the day in the DAX. This is often the case, that you can get these big critical turning points on option expiry time, but being very aware of when those times are can help you with your day trading in the DAX and in the FTSE, and in a longer term view on the S&P that we'll look at in a moment. Now, there is an assumption that you understand what options are. We're not going to spend too much time explaining what a call option looks like or what a put option looks like. If you're not familiar with put options, it might be worth pausing this and having a little read about it, because we're going to dive into put options in a big way in a moment. So options were created many moons ago, before the likes of kind of computer trading, and this is why options used to be expiring on quarterly bases only. So we had option expiries that were occurring in March on the S&P, in June, in September, and in December. These quarterly options still exist, along with a lot of others these days. But initially, because it was hard to kind of process this stuff, it was all done kind of centralized. It wasn't easy to kind of create the technology to do this more frequently. These options were expiring each month. As technology advanced, we then started to get monthly options, and these would expire at the same time every month. This is what we're going to talk about in more detail today. Since then, there's been weekly options expiring every Friday, and since 2021, the 0 DTE, the 0 day to expiry option, single day options now exist. used a lot by US retail traders and US institutions, or institutions all over, who want to trade the S&P and the NASDAQ. And this is possibly the best new product launch we've had in markets, maybe since ETFs. It's been something that's hugely subscribed, and now more than 50% of the options traded on the S&P are these 0 days to expiry, 0 DTE options. We might talk about this another time. I certainly teach it in the classes here. But we're looking at these monthly options and these quarterly options with a little bit more interest. And if we can get a heart back to the screen for a moment, I'm going to show you when these options stop trading. So this is a calendar for the year. And if we can get a little link to the screen, Russell, and we can get options stop trading box, this green one here, you'll see, you don't have to be too bright to see that on the third Friday of every single month, January, February, March, we had option expiry. This rarely is moved to a Thursday in April. Whenever Good Friday, the bank holiday in the US is on, and in the UK, is on a Friday in the middle of the month, the third Friday of the month, it moves to the Thursday. But generally speaking, you're looking at this at the third Friday of every month. And we're doing this today on the third Friday of May. Option expiry, the 16th of May. So why are we interested in these monthly option expirations? Well, hedge funds, the likes of, well, hedge funds is quite a broad term, or used to be, hedging used to mean you'd go long one asset versus short another asset, and you try and, with a bit of leverage, squeeze the difference between those two assets. So let's say you were hedging Tesla's outperformance versus General Motors. You thought Tesla would do better than General Motors. You'd buy Tesla with some leverage, you'd short General Motors with some leverage, and it wouldn't really matter whether the stock market went up or down. You would squeeze that differential if the Tesla stock outperformed the General Motors stock. This was like a hedge fund, right? These days, hedge funds, kind of these market neutral hedge funds, don't really exist in the same way that they once did. That's because markets have just gone up and to the right for so long, right? We've been at all-time highs again this year in stocks. Hedge funds typically mean long-only funds, people who buy assets. So it's a bit of a broad term. I think funds would be better for it, but you often see this kind of substituted for one another. And for those short-only funds, well, they died a long time ago, right? There's not many of those guys left now sitting at all-time highs. I've been posted so many all-time highs over the years of my career. So these long-only funds, one of the most famous ones these days is the ARK fund run by Cathie Wood. She's a kind of tech titan of Silicon Valley. She tries to invest in the best tech companies for her clients, and her clients can be anyone. Anyone can invest in this fund. You could send money over to Cathie Wood, and she would have an obligation to you. There's a mandate, like a terms and conditions that you have between you and your fund manager, and hers is to buy the best goddamn tech stocks she can find. She cannot short the tech stocks, right? And she can't short pharmaceuticals. She is there to buy tech stocks. But a lot of these fund managers, they do have a caveat in their mandate to be able to buy put options as a hedge. So they can't short the market outright. They're going to be net long the market, but they may have put options available to them in order to manage their risk on the upside. For those of you, as I say, who aren't familiar with puts, please look at them. But a put option is effectively something that will pay you out if the market sells off or volatility spikes. This is a way. And these things typically work together. If we look at some of the sell-offs that we've had in the S&P, if we kind of hark back to the charts quickly, if I move over to the S&P, you'll notice that we typically rally up, kind of climb the wall of worry, or we go up the escalator and we go down the elevator, as they say in the States, right? Stock markets tend to go up pretty slowly but consistently, but when they come down pretty goddamn aggressively. So these put options tend to pay out very well in that situation because A, the market's gone down, but B, the volatility's gone up and you get paid double over effectively on those put options when that happens. So these put options are used as a way of kind of hedging risk a little bit for traders. And this is, or for these fund managers particularly. And these monthly expiries are quite an interesting turning point for when those insurance and when those policies effectively stop working, and then they have to maybe go and get another policy. So if we hark back quickly to the calendars, let's say you had all of your options in the May expiry and they were expiring today, right? You could wake up on Monday morning and go, right, I'm just going to buy loads of put options on Monday the 19th for the June expiry. And then I can just have my full exposure of the hedge that I want put on again on Monday. Okay. Well, if everyone did this, like anything, supply and demand is a thing. And if there's a lot of demand for a product on one particular day, guess what's going to happen to prices, right? That price is going to go up. So this isn't what traders do or fund managers do. They tend to try and pepper in and squeeze in little bits of hedge in the lead up to their shorter dated options expiring, so that on option expiry, when that hedge and that insurance policy goes away, that they still have some insurance, maybe all the insurance they need to run them through to the next month. Think about this in terms of car insurance, right? The beauty of car insurance is that you can set up an insurance policy with someone, you know the date that it expires, and the day or in the lead up to that policy expiring, you've already signed up with another policy that starts the day after that one finishes. So you have a constant smooth transition from insurance straight into equal insurance from one day to the next. This is a financial product. It doesn't work that way. You have to buy the damn contracts. So you could just do it all on the expiry day of the 16th, but if you did, or on the Monday afterwards, but if you did, there would be a surge in demand, higher prices. It's probably not the optimal time to be doing that. So what tends to happen is they buy into these options on the Thursday, the Wednesday, the Tuesday, Monday of the week before, even the week prior to that. They're already layering into the next month's insurance, so that when the insurance from May drops off, they still have their insurance that drops off in June, working as planned throughout. So if there are some shocks, they still have some cover. And let's use the analogy again for the car insurance, right? If you had two car insurances, maybe you bought one that started on the 12th, but your old one didn't expire to the 16th, well, you've got a week where you have two insurance policies. Wouldn't be a bad time to crash the car, right? If you could get the value of the car paid back by one insurance to buy a new car, and you could get paid back that money from the other insurance company to pocket, right? You're overinsured. This obviously doesn't work with insurance policies. Don't try this with car insurance or house insurance or anything else. But effectively, this is what's happening with options and with the insurance that a put option gives fund managers. They end up being overinsured in the run-up towards option expiry. So if you think of the car analogy once more, if you have too much insurance, you may not want to wrap the car around a tree, but you may be kind of motivated to be a little bit more reckless with your driving, right? You might want to do a little bit of damage here or there, or go a little bit harder than you would normally. Well, this is true in financial markets. If you have too much insurance, you're going to benefit too much if these markets go down, and you're not going to lose any money if they just stay flat. Why don't you try and get yourself in a situation where you really gear up your long position, so if the markets do go up, you can make money that way too. And this is what we see happening into option expiries consistently. We see typically these stock markets are going up, right? So tend to see trend continuation into option expiry, because as the markets like trends, and if the trends are going one way, these trends can be exacerbated as we run towards the Friday of option expiry, maybe the Thursday before, the Monday afterwards, but into this little window, this can be a time of trend continuation. We see this in the S&P 500 this week. Let's zoom in and take a look. This week, we have seen, well, this is Friday, this one that's printing now, right? But for closed days, Monday was up, Tuesday was up, Wednesday was up, Thursday was up. This was after what was a pretty clear uptrend. You know, we're looking at 9 out of 12 up days or something leading into this week. The trend was up, right? And that trend was exacerbated and exaggerated in the week leading up to option expiry. Why? Because they're overinsured and they're encouraged to be more leveraged in the direction of trend. This works both up and down, but it's something that you want to think about when you get towards that middle of the month, when you start seeing the calendar nipping towards option expiry. Maybe look at the trend that led it into that week and see if you can get that trend continuation towards option expiry. Then, why am I telling you this now, right? This has happened. What can I do with this information today for next week? Well, there is something you can do. And that is, assuming that you understand how options work, and this doesn't always work, nothing does, but often, because the markets have been so heavily geared into the expiries, when these hedge fund managers, after a wild weekend of a great week, wake up on Monday morning, they're like, yikes, I'm super long this stock market here, and I don't have the insurance that I had last week. Maybe I need to get rid of some of these long positions and start cashing in on those positions. And then you often see trend reversals in the week after option expiry. So this middle week leading into the third Friday can often be trend continuation, whether that's up or down. Typically that's up. And the week after, often, not always, you can see this market reverse, pivoting around that Friday, sometimes a Thursday, sometimes the Monday afterwards. We'll talk about the Thursday and the Monday in a moment when we look back at some examples. But we've had some pretty good examples of this over the years, which we'll go back and have a look at. And hopefully we understand why. It's all about insurance. It's all about positioning. It's all about hedging. And if they are hedged, they can push more. But when that hedge goes away, they need to stop pushing quite so hard. And the unwind of those trades can kind of make markets firstly breathe up when they're sucking in all that extra money, and then breathe out as the market re-rationalizes to normal levels. So this is all theory. Let's look at the markets for practice. So we've seen that run up into this one, but similarly, the start of the big move down that we had ahead of the tariffs. Yeah, let's take a look at this. The highs, all-time highs on the Wednesday, the 19th of February. Well, we'd had this had been a bull market. This was an all-time high. We had consecutive up days into that Wednesday. And then, well, this was the Thursday, the 20th of February. We had the start of a decline. And it was one hell of a decline, right? Look at that whole week. Monday, Tuesday, Wednesday, Thursday, Friday. It was a big unwind, albeit Friday was up. But even into the following Tuesday, we'd had one up day following the option expiry Friday, which on this occasion was this big move down on the 21st of Feb. We'll talk about the 21st of Feb in COVID in a moment. This also works on the upside. There's some nice examples. There weren't too many sell-offs last year, but there was a nice one into April of last year where we had a decline. The market had, from the beginning of April, April Fool's Day, we'd started to see a bit of softness coming through. Normally there's a bit of buying at the start of the month. Didn't happen in April. And then into that week of option expiry, we were at the lows relatively for the last kind of 20 trading days. So this week into option expiry was a downtrend. The trend continuation was 1, 2, 3, 4, all 5 days down. Until the Friday of option expiry, we posted the low, and that was the low for the year. It's been the low since, I think. Did we get one more wick lower? I don't think. I think that was it. So this was, one heck of a move. It's only that option expiry Friday. Even on the downside, you can see these trends kind of come and go. Go back to the previous year, into kind of 2023. Not all highs and lows are these levels, by the way. This isn't the only way that markets work. But if you look into 2023, into May, right, we were kind of pushing highs at that point. We got these kind of, wasn't quite as clear, but we got that big push up Wednesday and Thursday of option expiry. Let me zoom into this a little bit clearer. Into the option expiry, the third Friday of May, and then we got a 120-point unwind into the middle of the following week. Fast forward a month, we started pushing on as we approached the June expiry. 1, 2, 3, 4, 5, 6 consecutive up days into Friday the 16th of June. Friday the 16th of June is a quarterly expiry as well. They call this triple witching, quadruple witching, right? These are where the monthly and quarterly individual stock options, index options, all expiring at the same time, right? You might hear this witching term come through again next month. And then another 100-odd point unwind, right? One up day out of the following 5. So some pretty nice examples in here. Go back to the big sell-off in 2022. That interest rate hikes came through where the market hated life. Well, some really hated it into the kind of middle of that June expiry. We sold off all the way down, aggressively down, only one up day until option expiry, the witching expiry on the Friday the 17th of June. Rallied up, didn't do much in the July one, but it was kind of the day, it was the week, to be fair, of the August expiry. We started the unwind once again. And the best example of all, everyone, or a lot of people, think that COVID was a virus, right? I'm not here for the conspiracy theorists either, by the way. You're not my guys. But the truth of markets around COVID was we were rallying to all-time highs into February of 2020. The all-time high was posted on Thursday, the 20th of February at the time. Option expiry was the 21st, and then the unwind began. Is this a coincidence? Maybe. But what makes me think it isn't is how long did this unwind last? This COVID move, this virus, unwound until Friday the 20th of March was the option expiry, the witching expiry, the quarterly option expiry, and the monthly expiring on the same day. The following day, we had a gap open lower over the weekend. That was the low. We have never seen these prices again, and I doubt we ever will. So these option turns after option expiry are pretty powerful as well. Not only do you get that lead up in terms of trend continuation into option expiry because of the hedging, but you also, when that hedging is gone, you get a kind of breathing out of all of that excess. And we've seen these turns happen again and again and again. And yeah, had you managed to get long here, you'd still be long today. And yeah, you'd be sitting fairly pretty. So what does this mean for today? Well, I would suggest there is an opportunity into next week that maybe, just maybe, after such a kind of gluttonous rally up, we've had 3 up days now since, well, the last one before that was the 21st of May. So we're knocking on for the best part of a month, 3 down days. I think this is due for a correction of sorts. Can we get this as the breathe out, the option expiry trend reversal into Monday of next week? And maybe this can be something that might be that little bit bigger. It remains to be seen. There's no guarantees with this. Like anything in trading, as we say, nothing works all of the time. So hopefully that's a good understanding of how option expiry works, why it is interesting, and how you can use it in the lead up to option expiry and on option expiry in those short-term moves, what not to do on the day of option expiry, as we saw in the FTSE and the DAX, and then what you can do in the week after option expiry. You know, months are 4 weeks long. This is a plan for 2 of them: trend continuation, trend reversal, and a little bit of warning for that option expiry day, as we sit here today on option expiry. So yeah, said those words a lot today, but it's been something we've been speaking about all week. We called this rally at the start of the week on our channels. If you do want to join them, please reach out and we'll get you in touch. But yeah, in the absence of D, hopefully that has been useful information, and we'll be back talking about Trump and news and everything else, I'm sure, next week. I've been Chris Pollock. Thanks for joining.